This meeting of the board is a hybrid physical virtual meeting. I'd like to welcome everyone, those in the boardroom with me today. I don't think we have anyone attending virtually this month. Also, just like to make a quick note of Patriot Day, which is recognition of those tragic events 24 years ago. And it's always remember those days. So if you would, keep your microphone muted and please join me in a pledge of allegiance. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice. This time, I'll ask the secretary to the board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting, Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
The secretary will now read an opening statement on the Government and the Sunshine Act.
This is an open Farm Credit Administration Board meeting under the Government and the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government and the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is. I move to adopt the agenda as published.
I second the motion. The motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portion of the meeting should be closed to the public.
Mr. Chairman, the agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
I second the motion. The motion has been made and seconded. Is there any further discussion? If not, the secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. If you will, please turn to tab 1, and this is the next item on the agenda, which is approval of the minutes as presented behind tab 1.
I move to approve the minutes for the August 14th, 2025 regular board meeting as presented.
I second the motion. The motion has been made and seconded. Any further discussion? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Please turn to tab 2. This time, I'll ask Greg Lyons of ODAE and Deanna Block of OE to present the quarterly report on economic conditions and system conditions and performance. This is an information item. Greg.
Chairman Hall, Board Member Smith. My name is Greg Lyons of the Office of Data Analytics and Economics, here with my colleague Deanna Block to give this quarter's report on economic conditions and farm credit system condition and performance. Next slide. In the first item, I'll be going through the economic conditions affecting the farm credit system before passing it off to Deanna to talk through the farm credit system condition and performance. Next slide. So through the first half of the year, what we observed is an economy where growth was positive, but was showing signs of moderation. Now, in the black dashed line on the chart on the left here, what you're seeing is overall GDP growth, which was very volatile. But this was driven by changes in net exports as well as changes in private inventories, which were responding to changes in private inventories. When we look at features that were related to domestic spending, personal consumption expenditures or fixed income, what we saw was a moderation in that spending, about a 0.5 percentage point through the first portion of the year. And we're likely to see additional volatility in GDP growth going forward as underlying factors that influence GDP, such as labor force size and individual worker productivity, are in flux in ways that they haven't been in prior years. But the main driver of economic expansion over the last several years has been continued growth in personal consumption. And we are starting to see specific patterns there. Notably, for most households, what we saw was a buildup in savings through 2021 that they spent down through 2025. And for most households now, they're spending in line with trendline expectations from 2020. But for the highest earning households, we still are seeing them spend above trend line expectation. So a lot of the growth that we're seeing is coming from those highest earning households. That said, we are starting to see some signs that consumer strain, which had been building, is beginning to wane. We've seen credit card volumes begin to slow their growth, and we have seen real declines in delinquency rates for credit card debt as well as other types of consumer loan. And we've seen personal savings rates stabilize after they'd been lower in the earlier portions of this year and last. Turning to fixed investment, another major driver of GDP growth, we are seeing a lot of short-term factors that will lead to volatility in these series over the near term. Recent changes in tax policy are expected to have an increase in fixed investment over the next few quarters, and trade policy uncertainty is likely having a dampening effect on some fixed investment, though that will wane as uncertainty resolves. Finally, there is a lot of influence of investments in AI infrastructure, which was a major contributor to GDP growth and fixed investment in the first quarter. However, that is driven predominantly by a small number of large firms and is not a broad-based growth among all firms. Next slide. Next, the story for inflation this year is that we have seen persistent residual inflation, and that holds true even in the wake of the latest CPI numbers released this morning. But we have seen a change in the underlying composition of what's driving that inflation. Notably, service inflation, which had been the majority of all inflation over the last year, has been falling as housing inventories have risen, and we've seen that new rental cost growth has been slow. Both of these things pointing to continued reduction in shelter inflation over the coming quarters. But we have seen rising cost growth in other segments, namely things like medical care, transportation, airline fees were all major contributors to the last CPI update, which were the same drivers as the one in the report released this morning. And we have seen some variation in food categories. Food inflation did tick up a little bit as well this morning, but we're not seeing the broad-based increases that we saw back in 2022, 2023. Now, notably, observing any impacts from changes in trade policy will take time. First of all, early indicators are noisy, and those costs are not immediately passed along to consumers. Things like the inventory buildup that we observed in the first page with GDP do help delay those cost increases, but we are beginning to see evidence that those costs are being passed along. In one survey by the Federal Reserve Bank of Richmond, they found that 46% of firms had found that tariffs had led to some amount of cost increase, and 82% of those firms had indicated that they either had passed those costs along or were going to pass those costs along in the coming quarters. Next slide. Next, in the labor markets, what we have seen is increasing signs of softness, though there is some clarification needed here. Now, first, top-line levels are holding steady. The unemployment rate is still relatively near full employment. But one important feature here is that the labor levels that we're seeing might not be reflective of the actual amount of strain that the economy is under. Right now, it does appear as though the labor force population is growing more slowly, and when that happens, that same labor level number may not correspond to the same amount of strain. And we also do see that wage growth is slower and still positive, still a sign of that residual strength in the labor markets that we've seen. That said, there is clearly stress underneath the surface here. We have continued increases in multiple job holders, and most of the job growth that we've seen over the last year has been driven by growth in healthcare and social services. In fact, more than half of all sectors have seen year-over-year declines in the number of jobs. We also see a significant divergence between job holders and job seekers. This chart on the left here is showing the share of workers who are on continued unemployment claims, that is workers who have been unemployed for 2 weeks or longer, and we've seen that number tick up this year relative to prior years. And there's a lot of data to support this point. The average number of weeks unemployed is rising, there's been declines in job switching premiums, and we've seen steep declines in young worker wage growth, all pointing towards an economy that is more difficult for those who are either out of the labor force or are currently seeking a job. Next slide. Taken together, the totality of the data has caused markets to expect the Federal Reserve to emphasize its full employment mandate in the coming weeks. And in their own communications, the Federal Reserve has noted that they do see that this modest residual inflation is largely a function of the inflation that we observed in 2022. Their base case is a one-time price shock based off of changes in trade policy, but the potential labor market weakness that we're observing, especially in conjunction with the data that we've seen over the last several weeks, is really causing an emphasis of the labor aspect of their dual mandate. And in comments from Chairman Powell last month, he noted that We are near full employment, that inflation is significantly down from its peaks, but the balance of risks appears to be shifting towards the labor market. And we have seen that market expectations for rate reductions have increased significantly through the end of the year, though we'll have much more information on this when the Federal Reserve meets next week. Next slide. Turning to agriculture, the dominant story in agriculture continues to be strain among crop producers. In their latest projections, the USDA found that the average net cash farm income of corn and soybean producers would be near 15-year lows for the second year in a row. And the story for this is much the same as it has been over the last several years, that higher supplies, weaker prices, sticky input costs have led to the third year of weaker negative returns for many of these producers, which has led to a drawdown in working capital and an increase in strain in these markets. But importantly, there's also variation in that strain that producers are facing. For example, producers in the Northern Plains right now, who are heavily reliant on exports to China for soybeans, are seeing extreme widening of basis and storage shortages. Supply shocks, such as the growth in the Indian rice supply, has led to extreme strain for producers down in Arkansas who are heavily reliant on rice production. And in general, producers who bear the vast majority of their land costs are seeing a lot more strain than those producers who own most of their land outright. All of this is why for those producers who are most exposed to these factors, even despite the robust payments that they've been receiving over the last year, those payments will still not cover a majority of the losses that they have received over the last several years. Turning to the livestock side, we are seeing that the livestock sector, we're still seeing record profits. This is driven mostly due to lower feed costs, very high prices, and improved pasture conditions around most of the U.S. And we do see that incomes are generally high across the sector. Cow, calf, and feeder operations are seeing profitability near record levels. In the dairy sector, we have seen that rises in inventories have cut slightly into their margins, but low feed costs are still generally supporting profitability. And even for sectors that had been showing strain, such as hogs, we have seen profitability levels rise over the last quarter, which will hopefully begin to work its way through those strained sections of the portfolio. But here we do have several features to look out for. First is that those high prices may eventually begin to cut into consumer demand here, which is a potential risk. And we do have some places in the country where there are drought, such as in the mountain region and in southern Texas, which is expected to persist. For crop producers especially, though, there are several key sources of support, one being either changes in policy as well as ad hoc program payments, with the USDA projecting that direct government payments will increase by $30 billion in 2025, though some of those programs, such as the Supplemental Disaster Relief Program, are likely to spill over into 2026. And the USDA does project that we still are seeing improving sector solvency ratios. While this is a lagging measure, farmland values are generally holding up, even in places that are mostly directly tied to crop markets where we are seeing strain. Next slide. Now, again, one of the reasons for the strain in the crop sector is the persistent higher costs of inputs. After seeing a sharp reduction through 2023, many input costs either stayed flat or continued to rise, especially those costs like interest or labor or farm machinery. The good news for producers is that we are beginning to see anecdotal evidence of nominal price declines for some of these goods, especially for things like machinery, where we are hearing that auctions are a significantly underperforming expectation at this time, which could be suggestive of future price declines for producers. Next slide. Next, touching on risk to labor access. So the best data that we have on the composition of U.S. agricultural labor comes from the Department of Labor, who found that in 2022, 45% of all U.S. agricultural crop labor was undocumented, with another share of that labor being foreign-born, but having some form of documentation. Now, not all regions are going to have this same distribution. The majority of the Pacific agricultural workforce is foreign-born, although we don't know the exact share that is undocumented. And there is significantly less reliance in the Midwest and Plains, where the best data that we have would suggest that about 10% of that workforce is foreign-born. There's also high non-citizen reliance in select roles, where we know that 60% of graders and sorters are foreign-born, as well as 30% of those in animal processing facilities. All of this just leads to potential risks for costs for producers, where we have signs of tightness in the ag labor markets. Notably, we've seen increase in H-2A wages in 2025, and we are seeing a lot of producers have to consider mechanization decisions, especially those who are highly exposed to labor costs. Next slide. Next, within agricultural exports, U.S. soybean commitments have been receiving a lot of coverage, but the top line story for agricultural exports is far better than that picture might paint. U.S. total exports in 2025 are likely to be in line with the export volume in 2024, and the latest USDA projections for 2026 are not that different from what we have for 2025. And a lot of this is because we're seeing significant variation across commodities. In dairy, we've seen continued expansion of exports to our USMA partners. For corn, we're seeing expanded exports to places like Japan and South Korea, and we've seen continued growth in tree nut markets, such as those like India. And we are seeing places where we're seeing contraction. Notably, we're seeing a reduction in meat exports both to China, but to several low and moderate income countries across Southeast Asia. And we did see a large reduction in soybean exports through this year, driven almost entirely by a reduction in Chinese demand. Now, we are almost certainly going to see shifts in trading partner importance this year. China is almost certainly going to fall out of the top 3 export destinations for U.S. products for the first time in many years. But we have seen growth in other Asian countries that will help make up for that in part, not just to Japan and South Korea, but to also places like the Philippines and Vietnam. Now, one important thing is that obviously the specific bilateral relationships may drive shift in the era of changing trade policy. What we have seen to date is that China has currently made no new commitments for the current soybean crop, but in addition, they have also reduced their demand for all U.S. agricultural products. Now, again, many of those other areas where we've seen declining demand, like corn, meat, or dairy products, have found new destinations, but we're still seeing some difficulty in finding markets for U.S. soybeans. The real question here is whether or not we're seeing a change in global demand, or we need to find a way to reallocate the existing supply here. Now, the best evidence that we have of this is in 2018, 2019, during the last round of trade conflicts with China. We did see very weak soybean markets here, but we also were dealing with African swine fever, which had lower global demand. While there will be strain from reallocation of existing product, it is possible that if there is no specific demand destruction and no change to global supply, eventually we'll be able to reallocate at least a portion of those products that are no longer going to China. Next slide. Quickly turning to global weather influences, in general, conditions are favorable for crop production across much of the globe. In the U.S., we've seen generally favorable conditions and strong conditions across the entire country. There have been some caveats to this with the development of things like southern rust in the Midwest, and we have seen the USDA begin to reduce their condition expectations for that crop. We'll have more information on that when the first objective report for corn and soybeans is released tomorrow. We also do have in the Rocky Mountain region some amount of drought. Again, that stretches all the way through the Rocky Mountains and down into southern Texas, where we're having poor pasture and crop conditions, and that is expected to persist through next quarter. Globally, however, we have generally favorable growing conditions in most of America's main competitors, as well as major export destinations. In South America, both Brazil and Argentina have favorable conditions, which are leading to near record production and exports of both soybeans and corn. And we're also seeing strong conditions in both China as well as India, which is, again, part of the reason why we're seeing so much pressure put on those Arkansas farmers due to Indian rice supply. The only place right now in the globe where we're seeing poor conditions is in Eastern Europe. So generally what we're talking about right now is a position of higher supplies putting continued pressure on global stocks and prices. Next slide. Finally, turning to farmland values. Unexpectedly, the main drivers of farmland values this year have been weakness in crop markets, the relative strength of the livestock markets, but also non-farm influences, which are providing some amount of support. And I'll talk through that more in a little bit. But what we have seen is that in places that are heavily reliant on crop production that have very little non-farm influence, and again, this is places like Iowa, Illinois, eastern Nebraska, we are seeing a moderation in land values and potentially some declines even. But in places that are closely tied to the livestock markets, such as western Nebraska, we are seeing price increases for local farmland. And we are seeing warning signs. Cash rents have been flat or falling in some regions, and rent-to-value ratios are far below historic norms. We've also seen that there's been a shift from auctions to private sales, which could be indicative of a lack of confidence in open markets. But there are some other factors that will help support prices even as the fundamentals begin to wane. First, non-farm conversion to some non-agricultural use is an important driver, although those influences are very local. Next, the relative attractiveness of farmland and as an asset and continued thin markets always help support farmland values even during periods of strain, like we saw from 2016 to 2019. Next slide. So touching on non-farm influences, on the map on the left, which you're looking at in green, those are tree nut parcels in California, and those dots in yellow are parcels that have exited production within the last 2 years. And this points towards several non-farm factors that can influence values. Notably, along the West Coast, you'll notice that that cluster of yellow dots near the town of Gilroy, that is where there is some amount of urban premium where farmers can offload land for a higher value. And in the western portion, just west of Fresno, that area there is influenced by changes in local water policies. But even within that water district, there are many solar panel arrays that lead to highly localized premiums for producers who are in the immediate vicinity of those arrays. And again, that is a notable thing about non-farm influences, that they tend to be highly localized, but they can still offer producers an off-ramp. And in fact, in the transactions that we observed in California, these parcels were selling for higher values than parcels that remained in tree nut production. But these non-farm premiums can be volatile. On the right-hand chart, what you're looking at here is the per acre value of farmland based off its distance to a metropolitan statistical area. Those values on the right-hand side are those farthest away from metropolitan areas, and those on the left-hand side are those closest. And as time has gone on, we've seen that premiums for farmland closest to metropolitan areas has risen. But within the last year, that dashed line there, we saw that farmland on the periphery of an urban center, 20 to 30 miles out, had seen a big step back in value. And this could point towards a decline in urban premiums if people begin to feel that markets for residential land on the outskirts of cities might not be as strong as it once was. And this is something that we've seen before, such as in the aftermath of the financial crisis, when urban premiums for farmlands took a big step back. Next slide. However, in those places where we're not talking about farmland, non-farm influences, and we're mostly relying on crop production, this is an area where we are seeing that crop land quality matters. In Iowa, for example, we've seen for a year now that medium and lower quality land has been under pressure, even as the highest quality land that we see on the market continues to transact at fairly stable levels. However, if we expand this view out to the entire country and we look at corn and soybean parcels across the entire country, we don't see this difference in trend where medium and low quality land are not starting to see declines. And again, this is potentially due to the influence of these non-farm influences or the intermixing with the livestock market. So in those places where we do see the greatest reliance on crop markets alone, we are starting to see quality differentials, but that may not be true in other markets. With that, this concludes the economic portion of this presentation. And with that, I'll take any questions you have.
Board Member Smith, questions?
No questions. Good presentation, Greg.
Questions from me? Thanks, Greg.
Thank you.
Deanna?
Good morning, Chairman Hall and Board Member Smith and everyone else present. My part in today's presentation is to provide an update on the financial condition and performance of the Farm Credit System as of June 30th, 2025. Overall, the system reported sound financial results for the second quarter of 2025. In Q2, loan growth was modest. The system's portfolio continued to perform well, although we saw increasing credit risk. Non-performing loans, as well as provision for loan losses, were considerably higher in Q2 of 2025 compared to 1 year prior. However, earnings remained strong and system capital showed consistent growth. Finally, composite FERS ratings continue to be stable from the prior quarter. Next slide. Starting with growth, as I mentioned, system growth slowed in the first half of 2025. System loans totaled just over $436 billion, up 0.9% for the quarter and 7.3% year over year. The chart on the left shows year-to-date portfolio growth going back to 2016. Some seasonal slow growth is expected in the first half of the year. However, some of the slower growth was influenced by higher borrowing costs as well as uncertainty with the economic outlook. The chart on the right illustrates system loan growth in the main loan categories for the past 3 years. Collectively, these categories represent 96% of system loan volume. The decline in production and intermediate term loans is driven partly by seasonal paydowns, primarily on operating lines of credit, whereas the growth in agribusiness had to do with some of the growth we usually see this time of year with seasonal lending to grain and farm supply co-ops. Growth also was strong in rural infrastructure, which has been pretty consistent the last several years, and much of that portfolio is made up of the power sector, which is power generation, transmission, and distribution. Next slide. The next few slides focus on credit quality. While portfolio credit quality remains sound, as I mentioned, we did see an increase in credit risk that continued to trend higher in the second quarter. As of June 2025, non-performing assets totaled $4.5 billion, up from $4.1 billion last quarter and up from $2.6 billion in June of 2024. Non-performing assets as a percentage of loans outstanding and other property owned increased to 1.02%, which was an increase from 0.96% last quarter and an increase from 0.64% a year ago. Non-accrual volume, which is about 90% of the non-performing assets, increased to $3.9 billion. Credit deterioration has occurred in several stress sectors, including hogs, tree fruits and nuts, and various food processing related sectors. The chart on the right shows non-accruals as a percentage of loans outstanding, and non-accruals increased across all loan types. Persistent low to negative margins in a number of industry segments has reduced producer cash flow. Additionally, macroeconomic factors, including the strong global production, a strong dollar, tariff and trade uncertainties, has negatively impacted many agribusiness companies. Overall, non-accrual agribusiness loans more than doubled between June of 2024 and June of 2025. Next slide. Along with the trend of increases in non-performing loans, we saw an increase in less than acceptable loans. This includes loans classified special mention, substandard, doubtful, or loss, and those designations represent accounts with potential or well-defined weaknesses. The chart on the slide shows the percentage of loans within the portfolio classified less than acceptable by major loan category, and loans classified less than acceptable increased across all of these categories with the exception of rural infrastructure. System-wide, less than acceptable volume increased to 5.9%. This was up from 4.7% in June 2024. Delinquencies increased slightly as well, but remained low. Next slide. Moving into earnings, the system reported strong earnings in Q2 with net income of $3.9 billion. This was down just slightly from 1 year prior. The line in the bottom of the chart shows the provisions, the increase in provisions relative to net income levels, and you'll see that the credit provisions in Q2 increased to $550 million year to date compared to $159 million for the same period a year ago. The chart on the right highlights the changes in the key components of net income. Primarily, we saw an increase in net interest income, but we also saw an offsetting increase in the loan provisions, as I've discussed. So although the net interest income was up $357 million compared to a year ago, it was offset by that increase of $391 million in additional provisions for loan losses compared to the prior year. Next slide. Year to date, the system experienced slight spread and interest margin compression. The chart on top shows that the net interest spread declined 3 basis points from year-end 2024. This was largely related to competitive market pressures. The net interest margin declined 6 basis points to 2.35% as compared to year-end 2024. This captures that compression to the spread as well as compression to interest earned on assets funded with capital. Although the net interest margin is down compared to last year, net interest income did increase $357 million year to date. This was driven by growth in the level of average assets. The chart on the bottom highlights the year-over-year changes to average earning assets. As the chart indicates, average earning assets grew 8.7% to $532 billion. Next slide. The system continued to maintain sound capital levels with strong earnings that continue to support consistent capital growth. As of June 30th, system capital totaled $82.4 billion, up $5.5 billion or 7.2% year over year. The capital to assets ratio decreased slightly to 14.8% compared to 14.9% a year ago, but it's remained relatively stable over the last 3 years. As noted in the slide, regulatory capital levels at all system banks and associations remain sound and continue to be well above regulatory minimums. Capital and allowance for credit losses equaled 19.3% of total loans outstanding, and 73% of system institutions had a 1 rating for capital, while all others were rated in the 2 range. Next slide. So moving into the FERS rating for the system-wide portfolio, for individual institutions, the composite FERS rating represents an overall assessment of the safety and soundness of that institution. The chart on the slide provides a snapshot of the combined composite FERS ratings for all banks and associations. Overall, the composite FERS ratings for the second quarter continue to reflect the system's sound financial position. 2 institutions had a composite rating of 3 or worse, and that was unchanged from year-end 2024. The remaining 57 institutions had a composite rating of 1 or 2. In total, 4% of system assets are held by institutions rated 3 or worse. Next slide. To end, I'll touch on some of the risks we're monitoring. Agricultural producers and system institutions have faced a challenging operating environment in 2025. Changing economic conditions and an uncertain growth outlook for both the U.S. and world economies present substantial challenges in agriculture. Grain producers continue to face considerable margin compression as large loan production levels, elevated production costs, and export uncertainties put downward pressure on prices. Other commodity segments like tree fruits and nuts, hogs, and certain farm-related businesses remain under stress, and these sectors face non-feed production costs and uncertain demand levels. Lower net farm income and elevated interest rates also have an implication on farmland and collateral valuations. So as the last bullet highlights and some of the economic points that Greg touched on, there are a number of factors that could affect agriculture. And in this challenging environment, I just want to emphasize that the system is financially sound and institutions are well positioned to continue to meet borrower funding and liquidity needs. That concludes my part of the presentation. Thank you for your time and attention, and we're happy to take any questions.
Member Smith?
Yeah, Deanna, just one question. Normally, it's been pretty tepid growth in loans up to this point, but normally you see an increase in loans towards the end of the year as you get into prepays and all that. With the low prices, I think there'd probably be a tendency, I would think that'd be even more so with the propensity of people needing to borrow to cover prepayments. Any discussion within OE as to what that growth will be in that final quarter of 2025?
I think most of the institutions are projecting an increase in growth in the second half of the year for partly reasons such as the one you mentioned, also due to the potential decline in rates really helping fuel some of the growth in capital markets lending. So I think given where we're at in the year, a lot of institutions are still projecting loan growth to fall more in line with their original business plan projections, even though a lot of them are tracking behind right now.
Okay. Thank you. Thank you, Mr. Chairman.
You know, another piece of that too, I mean, we're facing what could be a record crop, and, you know, we see a lot of activity for storage, grain storage, and shortage of facilities to be able to do that. So, you know, sometimes in those years, you see a lot of activity for grain elevators. So they're probably factoring that in too.
They're actually selling a lot of bags, if you can believe it, big plastic bags that you store on the ground, temporary storage. So yeah, you're exactly right. Yeah. It'll be a tough situation for storage.
Tough situation having that many bushels. Yeah, it's kind of hard
to
reconcile all that. Yeah.
Yeah, exactly. Yeah.
That's all, Deanna. I appreciate your coming in for the presentation, and good job. Thank you.
Thank you. Thank you, Chairman Hall and board members. Ben.
If no further questions, I'll ask you all to turn the adjournment tab. And if there's no further business to bring before the board, I will entertain a motion to adjourn the meeting.
I make a motion to adjourn the meeting.
Second the motion. The motion has been made and seconded. Is there any further discussion on the matter? If not, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Meeting is adjourned.